Sarah had $47,000 in her savings account. Then the Federal Reserve made an announcement that most people scrolled past without reading. By Wednesday morning, that $47,000 was actively working against her. Not because the number changed. The balance was still $47,000. But the purchasing power of that money? That was eroding in real time, and Sarah didn't even realize it was happening. Here's the part that should bother you more than it does: the Federal Reserve isn't trying to hide what they're doing. They announced it publicly. They explained it in statements. They showed you the math. And 90% of people with savings accounts have no idea what it means or how it's destroying their money. My name is Money Sketcher, and I spend way too much time thinking about the exact moment people realize their saving strategy was built for a world that doesn't exist anymore. Because here's the thing: if you've got money sitting in a regular savings account earning almost nothing while inflation is running at levels most people have never seen in their lifetime, you're not saving. You're slowly disappearing. And the Fed just made a move that made this problem significantly worse. Stick around and hit subscribe, because in the next few minutes, I'm going to show you exactly what happened, why it happened, and more importantly, what you need to do right now to stop watching your money die in a savings account. Hold on to this: the answer isn't what you think it is. Before we go any further, let me be straight with you about something, because it's the whole idea this video is built on. I'm not a financial advisor, and this isn't financial advice. This is just what I've watched happen over and over when central banks make major moves, and what the actual data shows about what happens to people's savings in the aftermath. And here's the uncomfortable truth that separates people who understand what's happening from people who just watch their money slowly disappear: the Federal Reserve doesn't work for you. They work for the system. And sometimes, those two things are in direct conflict. Let me show you what I mean. The Federal Reserve just signaled that they're going to keep interest rates higher for longer than most people expected. That sounds like boring economic policy. But it's actually the most important financial announcement you didn't pay attention to. Here's what's actually happening underneath that statement. For the last few years, the Fed kept interest rates at historically low levels. Which meant banks had to pay you almost nothing on your savings. A regular savings account might earn you 0.01% on your money. That's a penny on every $10,000 you save per year. But here's the thing nobody tells you: when the Fed keeps rates low, they're keeping them low on purpose. It's designed to push you out of savings and into spending or investing. The whole idea is to stimulate the economy by making it pointless to save. So people didn't save. They spent. Or they borrowed, because the interest rates on loans were low too. The system was designed to make borrowing attractive and saving pointless. And for a while, that worked. The economy moved. Money flowed. But it came with a cost that's now showing up on your grocery bill and your gas pump. Inflation exploded. And while inflation was exploding, people with savings accounts were getting paid nothing for their money. Think about what that actually means: your money was losing value while you earned nothing on it. You were doubly punished. Losing money to inflation and losing interest you could have been earning. Now, the Fed has finally raised interest rates. Which sounds like good news. Higher rates mean your savings account will earn more, right? Wrong. And this is where it gets infuriating. The Fed raised rates. But here's what they didn't do: they didn't retroactively compensate you for the years you lost money to inflation while earning nothing. And here's what happened instead: the economy started to struggle. Because the whole economy was built on low rates. Businesses took on debt at cheap rates. Homeowners took on mortgages at cheap rates. The entire system was designed around the assumption that rates would stay low forever. So when the Fed raised rates, suddenly that cheap debt became expensive. Suddenly those business loans cost more to service. Suddenly those mortgages became harder to afford. And the economy started to contract. Which means the Fed is now signaling they're going to keep rates high to fight inflation, even though the economy is struggling. And that's the move that destroys your savings. Because here's how this actually plays out. High interest rates are good for savers, right? You earn more on your money. But high interest rates are terrible for the economy. And when the economy struggles, two things happen: unemployment goes up, and companies struggle to stay profitable. Which means if you're a saver with money in a bank account earning 4% or 5%, you're earning decent interest. But simultaneously, the odds that you lose your job just went up significantly. The Fed is essentially saying, we're going to make it slightly better to save money, but we're also going to increase the odds that you need that money for an emergency because the economy is weakening. That's not a solution. That's a problem wearing a different hat. Here's the part that most financial advice gets completely wrong. People say, just put your money in a high-yield savings account and you'll be fine. And sure, a high-yield savings account is better than a regular savings account. You might earn 4% or 5% right now. But here's what those people aren't telling you: inflation is still running higher than that. The official inflation number that the government publishes is around 3% to 4%. But that's using metrics that don't match your actual life. The real inflation number, the one that actually affects your grocery bill, your rent, your utilities, your healthcare, that's significantly higher for most people. Some estimates put real inflation for an average household at 8% to 10% per year. So you put $100,000 in a high-yield savings account earning 5%. You feel like you're ahead of the game. But if real inflation is 8%, you're actually losing 3% of your purchasing power every single year. That $100,000 is quietly becoming worth less and less, even as the balance stays the same. And the Fed's move to keep rates higher is supposed to fight that inflation. But it doesn't fix the fact that you've already lost years of purchasing power while the rates were low. The Fed doesn't compensate you for that loss. They just move forward like it never happened. Let me show you what this actually costs you over time. Imagine you had $50,000 saved in 2019. That was a reasonable amount of money. It could buy a decent used car, or cover a semester of college, or be a solid down payment on a house in many parts of the country. Now it's 2024. The number in your account might be $55,000 because you've been saving. You feel like you're winning. You saved $5,000 more. But that $55,000? It doesn't buy what it used to anymore. That decent used car now costs $30,000. That semester of college now costs $40,000. That down payment doesn't go as far. Your money grew by $5,000. But its actual value shrunk by more than that because of inflation. And here's the thing that should make you furious: this is intentional. The Fed uses inflation as a tool. They call it controlled inflation or healthy inflation. They literally target 2% inflation per year on purpose. They think a little bit of inflation is good for the economy because it pushes people to spend and invest instead of hoard cash. But that 2% inflation target is just what they want to happen on the official numbers. The real inflation is higher. It always is. And the people who get hurt most are the people who try to be responsible and save money. Because savers get punished by inflation. Borrowers get rewarded. If you borrowed $100,000 and inflation ate 8% of the value, you just paid back the loan with money that's worth 8% less. You benefited from inflation. But if you saved $100,000, inflation just erased 8% of its value. You got punished for being responsible. This is the core mechanism that slowly transfers wealth from savers to borrowers. And the Fed is fully aware of it. They just don't talk about it in those terms. The Fed's announcement that they're keeping rates higher for longer is important because it signals something deeper. They're choosing inflation fighting over economic growth. They're choosing to sacrifice short-term economic health to deal with the inflation problem they created. Which means they've officially given up on a soft landing, the fantasy that you can fight inflation without causing a recession. They're now openly accepting that there's going to be economic pain. Unemployment will probably rise. Some businesses will fail. People will lose jobs. But they're betting that this pain is worth it to bring inflation down. Here's why that matters for your savings. If the economy weakens significantly, the Fed will eventually cut rates. They have to. You can't have high unemployment and a contracting economy and keep rates high forever. At some point, they'll flip and start cutting rates to stimulate the economy again. And when they cut rates, the high-yield savings account earning 5% will suddenly be earning 2%. Maybe 1%. Maybe less. So the people who moved their money into high-yield savings accounts to take advantage of the 5% are going to see that rate cut in half or more when the cycle turns. And if you didn't move your money into a high-yield savings account, you're still earning 0.01% on your regular account. Either way, you lose. The saver's dilemma: if you go for the current high yield, you're chasing returns that are about to disappear. If you don't, you're earning nothing. Both paths lead to losing money in real terms. Here's what every financial advisor is going to tell you right now. Put your money in a high-yield savings account. Diversify into bonds. Consider the stock market. It's been down, so now's the time to buy. And sure, those aren't terrible advice. But they're missing the actual point. What they're not telling you is that all of these strategies assume the current system stays stable. They assume that high-yield savings accounts will keep paying decent interest. They assume that bonds will stabilize. They assume the stock market will eventually go up. But they're not accounting for the fact that the Fed's move destabilizes all of these assumptions. High-yield savings will get crushed if rates fall. Bonds will get crushed if rates rise further. Stocks are volatile in an uncertain economy. The advice they're giving you works when the system is stable. But the Fed just signaled that the system isn't stable right now. We're in a period of major change and uncertainty. And in uncertain times, the traditional advice stops working. So here's what actually works in this environment, and it's the opposite of what most people do. First, stop thinking about your savings as an investment. Your savings account isn't supposed to make money. It's supposed to protect you. It's supposed to be accessible. It's supposed to be stable. The moment you start treating your savings account like an investment vehicle, trying to squeeze 4% or 5% out of it, you've already lost. You're optimizing for the wrong thing. Second, build your emergency fund in a way that protects against instability, not against inflation. This is crucial. Your first $10,000 to $15,000 should be in an actual savings account, somewhere you can access it in 24 hours. Not a high-yield account. Not an investment. Just a savings account. Protected, stable, accessible. Because in an uncertain economy, liquidity is more valuable than yield. Having money you can actually access is more important than earning an extra 3% that might disappear when rates change. Third, once you've got that stable base, then you can think about the rest. Anything beyond your emergency fund should be in things that actually protect against inflation and the Fed's moves. Real assets. Land, real estate, things with actual value that inflation can't erode. Productive businesses. Not stock picking, but actual ownership stakes in things that generate income. Skills and income growth. This is the most valuable asset in an uncertain economy. The ability to earn more is worth more than any savings account could ever be. Diversified inflation hedges. Not all in one thing, but things like commodities, inflation-protected securities, things that actually move with inflation instead of against it. The point is, stop trying to beat the system with a savings account. The system is rigged against savers. Accept that. Protect yourself differently. And listen, everything we've talked about so far is about understanding what the Fed is actually doing and protecting yourself from it. That's the defense. But there's an offense. And the real wealth building that happens in uncertain times comes from people who understand what's actually happening and position themselves for it. I've put together a breakdown over on my channel about how I personally navigated the last 3 Fed cycles, how I positioned my money, what I moved, when I moved it, and how I came out ahead while most people lost ground. It's step by step, no fluff, just the actual playbook. If you want to see how to turn a Fed rate cycle from a threat into an opportunity, check the description. It's there if you want it. No pressure. Let's keep going. Here's the thing that stops most people from doing anything about this. Inaction feels safer than action. Leaving your money in a regular savings account feels safe because at least you're not losing it to the stock market, right? But you are losing it. You're just losing it slowly, invisibly, in a way that doesn't feel like loss because the balance isn't going down. Psychologists call this hyperbolic discounting. We weight immediate visible losses as much heavier than slow, invisible losses. So losing $1,000 on a stock investment feels catastrophic. But losing $2,000 per year to inflation and low interest rates? That feels fine because you don't see it happening. The Fed is betting on this psychology. They're counting on people not understanding what's happening and not taking action. Because if everyone suddenly moved their money into real assets and inflation hedges, the whole system would have to rebalance. But people don't. They leave money in savings accounts earning nothing. They convince themselves it's safe. And year after year, their purchasing power quietly disappears. Now, I want to be clear about something. I'm not saying act right now or panic. But I am saying that the Fed's move just changed the game board. And the moves you make in the next 30 to 60 days will determine whether you're positioned ahead of the next shift or behind it. Because here's how this cycle usually goes. The Fed raises rates. People feel scared. The market drops. Everyone panics and talks about recession. Then, once things get bad enough, the Fed starts cutting rates. The people who moved early to safer positions are fine. The people who stayed in cash get crushed by rate cuts. The people who panic sold at the bottom lose everything. The people who win are the ones who understood what was happening 6 months before everyone else and positioned for it. You're about 6 months into understanding that the Fed is serious about keeping rates high. Which means you're roughly 6 months ahead of the panic phase. Use that time. Don't panic. But don't do nothing either. Let's go back to Sarah for a second. She had $47,000 sitting in a regular savings account earning almost nothing. When the Fed made their announcement, nothing changed about her balance sheet. But everything changed about her situation. Because now she understood. Now she knew that money sitting in that account wasn't safe, it was slowly disappearing. So she moved. Not all of it. She kept 3 months of expenses in an actual savings account. Still accessible. Still safe. But protected. And the rest? She moved it to places where it actually works for her. Real assets. A business she owns. Things that generate actual returns and protect against inflation. A year later, while everyone else was watching their savings accounts erode, Sarah's money was actually doing something. It was protecting her. It was growing. It was working. And here's the thing that most people miss: she wasn't taking crazy risks. She wasn't day trading. She wasn't trying to beat the market. She just understood that the old strategy of save money in a savings account doesn't work in a world where the Fed is actively trying to punish savers. So she adapted. And that's the whole point of this. The Fed just made a move. Most people will ignore it or misunderstand it. They'll leave their money where it is and slowly watch it disappear. But you understand what just happened. You know what's coming. And you know that the old strategy doesn't work anymore. So here's what I want you to do: this week, move your emergency fund to a real savings account, something accessible, something stable. Then, for the rest of your savings, sit down and ask yourself, is this money actually working for me, or is it slowly disappearing? If the answer is, it's slowly disappearing, it's time to move it. You don't need to do it all at once. You don't need to panic. But you need to start. Because the Fed just changed the game. And the people who adapt fastest are the ones who come out ahead. This is Money Sketcher. I'll see you in the next one. Just a reminder, I'm not a financial advisor and this video is for educational purposes only. Any financial results depend entirely on your own decisions, and you should consult with a qualified financial professional before making any financial moves.